Have you ever wondered if paying off debt early is better than investing more? Many people face this dilemma when they want to achieve financial freedom. In this video, we'll show you why conventional wisdom may not always be right and how paying off debt can have some surprising benefits that you may not have considered. Stay tuned to find out more. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit that subscribe button and click the notification bell right now. Let's start demystifying the benefits of paying off debt early with a quick story on Jen and Amir. Jen and Amir graduated college with the same degrees and salaries. Amir started investing aggressively for retirement right away. Jen focused on paying off student loans first before investing. 10 years later, conventional wisdom says Amir made the smarter financial move by capitalizing on early compound growth. But Jen reached debt freedom faster, gained flexibility to increase savings, and built resilience. When unexpected medical bills hit, Amir struggled while Jen's lean lifestyle provided stability. So who actually came out ahead? Jen's story challenges standard advice about paying off lower interest debt versus investing more. Conventional wisdom suggests paying off lower interest debt to invest more is financially unwise. However, the decision is nuanced with potential benefits to eliminating debt first. In this video, we'll explore 4 reasons why paying off debt can be better even if it reduces short-term investment returns. Reason number 1. Guaranteed returns. One of the main advantages of paying off debt is that you get a guaranteed return equal to the interest rate. For example, if you pay off a 46% debt, you are effectively earning 46% of your money. This is a risk-free and tax-free return that is hard to beat. On the other hand, market returns are unpredictable and vary significantly from year to year. Even though the historical averages for stocks and real estate investment trusts are around 7 to 10%, there's a 30 to 50% chance they will return less than 4% in a given year. Plus, they can see major losses like 37% in their worst years. So if you can pay off debt quickly, say within a year, you may not lose much in potential gains since markets frequently underperform interest paid on debt. And the quicker you eliminate debt, the less potential gains are forfeited. This is why deciding between debt repayment and investing weighs payoff timeliness versus likely market returns in that time frame. Reason number 2. Reduced investment risk exposure. To reliably beat low-interest debt returns, you would need to invest in volatile assets like stocks and REITs. These are assets that have high potential returns but also high fluctuations in value. However, not everyone can stomach the higher risk. In approximately 20% of years, these assets lose over 20%. That means you could lose a fifth of your investment in a bad year. If the market crashes while you are paying minimums on debt, you could face a double whammy of losing your income and your investments. This could put you in a worse financial situation than before. So is the 3 to 4% return spread between likely investment returns and interest rates worth the very real risk of underperformance, potentially by large double-digit amounts? The answer lies in your personal risk tolerance and the debt amount and payoff time frame. How much risk you can accept for a given return is your risk tolerance. Some people are more at ease with taking risks than others. The debt amount and payoff time frame are how much debt you have and how long it will take you to pay it off. The more debt you have and the longer it takes you to pay it off, the more interest you will pay over time. If you are risk-averse or have a large debt burden, you may prefer to pay off debt first and reduce your stress. By paying off debt, you are eliminating a fixed cost and a source of uncertainty. Moreover, you are freeing up cash flow that you can use for other purposes, such as investing or saving, which we'll talk about next. Reason number 3. Accelerated savings rate. Another benefit of paying off debt fast is that it unlocks cash flow to boost savings and investments. Yes, you sacrifice some short-term gains. However, the increased monthly savings can partially offset underperformance. Consider this example. Tom and Jane each have a $3,000 personal loan at 3% interest to pay in 5 years, so $54 monthly payments. With an extra $250 after expenses, Tom invests while Jane pays down debt. Assuming unrealistic 6% annual investment returns, in 5 years, Tom has $15,863 and Jane $15,850. By eliminating debt faster despite lower returns, Jane narrowed the gap through higher monthly savings and can now invest more. This effect would have been amplified if Jane made temporary lifestyle cuts to pay off debt even quicker. For instance, if she paid off the loan in 2 years instead of 5, she would have $16,378 in 5 years, beating Tom by $515. Reason number 4. Resilience against emergencies. Finally, paying down debt insulates you from income disruption risk and forced investment selling in down markets. If Tom loses his job, he may need to fund living costs with high-interest credit cards while selling investments at a loss. This could wipe out his savings and put him deeper in debt. On the other hand, the additional cash flow flexibility and lower living costs from eliminating debt build financial resilience. Math saying to invest more may work in theory, but personal behavior tendencies and risk tolerance matter. If you are more comfortable and confident with less debt, you may be more likely to stick to your financial plan and achieve your goals. Now, if we simulate different approaches over 10 years using historical market returns, the results highlight the nuance further. In the baseline case with no events, Tom investing more beats Jane eliminating debt first, but only by 2.4%. However, Jane catches up completely if she makes temporary lifestyle cuts, and she pulls far ahead in recession scenarios thanks to lower living costs and less investment selling. While paying down low-rate debt to invest more often makes mathematical sense, don't underestimate the guarantees, risk reduction, cash flow improvements, and resilience benefiting eliminating debt early instead. Evaluate your personal situation carefully beyond just headline return spreads. So, what do you think? Do you agree that paying off debt early can be better than investing more? Or do you have a different opinion? Let us know in the comments below. Thanks for watching and be sure to subscribe. Until next time.